Middle East shipping disruptions are choking freight lanes, while the surge in AI development has triggered severe inflation in memory chip prices. Across the board, global electronics manufacturing margins are under intense pressure. This hostile procurement environment hit Dixon Technologies directly in the fourth quarter of fiscal 2026, keeping their revenues completely flat. But zooming out to their full-year earnings call, the wider picture reveals a 26% jump, pushing total annual revenues to nearly 48,900 crores. Despite the intense macro pressures eating into Q4, the company funded massive capital expenditures and still generated over 700 crores in free cash flow, maintaining a return on capital employed of nearly 45%. That performance masks a looming structural challenge. The initial production-linked incentive, or PLI scheme, for mobile manufacturing is sunsetting. Without those government subsidies padding the bottom line, pure-play assembly margins will inherently compress. Building electronics the old way simply won't yield the necessary returns. The expiration of the PLI threatens to shave 50 to 70 basis points directly off operating margins. To counter this, management is actively cannibalizing their legacy, volume-based assembly model. They are rebuilding the company into a backward-integrated original design manufacturer. This requires directing massive capital expenditure toward internalizing the production of high-value components, rather than importing them. Institutional investors tracking top-line revenue growth will miss the actual mechanics at play. The real value is being generated deeper inside the supply chain. Dixon is using the expiration of the PLI as the exact catalyst required to capture a much larger, more profitable share of the global electronics value chain. Look at the bill of materials for a modern smartphone or laptop. In a legacy electronic manufacturing services model, nearly all of these internal components are imported from third-party suppliers, leaving the assembler with razor-thin margins. Dixon's solution is deep localization. They are systematically targeting the most expensive components on this list and bringing their manufacturing in-house. Through their Q-Tech subsidiary, they are scaling up captive camera module production from 70 million units annually to a projected 190 million units over the next 18 months. A 74-26 joint venture with HKC executes the same strategy for display modules. The physical infrastructure for this is already complete. Machinery installation is pacing towards trials in Q3, targeting full mass production for mobiles and IT hardware by Q4 of this fiscal year. Capturing these two specific components immediately traps profits inside the company that previously bled out to foreign suppliers. By expanding their manufacturing footprint to control these exact high-value items, the company mathematically offsets the subsidies lost from the PLI sunset. Physical component manufacturing is only half the equation. The other half requires migrating toward intellectual property and active design capabilities. In their telecom and networking vertical, they are actively moving away from pure assembly into a joint design and manufacturing model. We see this clearly in their recent shift to manufacture highly complex backhaul microwave radios, proving they can execute on this new joint design mandate. A parallel shift is occurring in home appliances. They recently launched industry-first 16 and 18 kilogram semi-automatic washing machines, utilizing their own engineering frameworks. In consumer electronics, production of high-end mini LED televisions is moving entirely to an ODM model by Q2, granting their client brands immediate access to the premium segment without having to design the units themselves. By offering these design services, the manufacturer embeds itself into a client's product cycle. This creates deep customer stickiness and stronger pricing power. Expanding into complex design and manufacturing requires massive capital, over 1,000 crores this year. How do you fund that without crippling debt? The answer lies in their working capital cycle, which currently sits at -8 days. A negative cycle means their day-to-day operations are effectively being funded by their suppliers. This tight cash management frees up internal capital, resulting in over 700 crores of free cash flow. That cash directly fuels physical expansion without straining the balance sheet, routing into projects like a 1 million square foot facility in Noida and a massive capacity upgrade for refrigerators. This strict balance sheet discipline yields a highly efficient return on capital employed of 44.8%. Superior asset utilization forms the protective moat. It ensures their aggressive evolution to an integrated manufacturer remains financially viable, even as macroeconomic environments cool. The immediate beneficiary of this cash-rich, highly integrated platform is the IT hardware segment. Management expects this division to scale roughly 3 times over the current fiscal year, targeting revenues north of 4,000 crores. Their new dedicated facility in Chennai has already stabilized mass production of laptops and all-in-one computers, and has now secured orders for desktop units. The backward integration strategy is clearly active here, executed through their joint venture with Taiwan's Inventec and the rollout of localized SSD manufacturing in Q2. Looking ahead, there is a clear pathway to enter enterprise server manufacturing, an initiative heavily supported by government tax holiday frameworks that improve long-term viability. The rapid scale-up in IT hardware proves that the localization playbook they built for smartphones can be successfully replicated across highly complex product categories. The final phase of this strategic roadmap pushes those upgraded capabilities to their logical extreme, high-end specialty EMS. Partnering with global consulting firms, they are laying the groundwork to enter aerospace, defense, automotive, medical, and industrial manufacturing. These micro-verticals represent scalable opportunities worth 3,000 to 4,000 crores. These sectors command significantly higher operating margins, structurally raising the profitability ceiling of the entire company. This specialty expansion is the direct reward for mastering deep localization and navigating the end of the mobile subsidy era. As the mobile PLI scheme sunsets, the reliance on basic assembly no longer provides the margins necessary for sustainable growth. The new playbook relies on capital efficiency to fund deep localization in components like displays and cameras, elevating the company to an original design manufacturer. Internalizing the bill of materials captures design value, retaining margins previously lost to external suppliers. This integrated structure provides a buffer against macroeconomic volatility, positioning Dixon as a more resilient partner within the global electronics supply chain.